I'm Mike Ward. I want to quickly take you through the mechanics of conducting an event study. The event studies are very common research methods used in finance to try and have a look at what happens, to share prices on average when events take place. So an event might be something like a listing or perhaps an issue of new equity, a rights offer, or it could be something like directors trading, when directors sell or buy shares, and a bunch of other things. And we have a standard way of trying to see what happens in general, on average, if you like, when a company does something. So let's assume that we want to do a rights offer. We want to raise more capital from existing shareholders. Now, I'm going to take you through the process of what we would do very quickly. So first thing we'd need is to get a set of data, and you can see here I'm just running a SQL code here, which is going to give me all the rights issues which have happened since 2005, rank them according to date, and this is going to be taken from the database on the Johannesburg Stock Exchange. Now I've already run this, and I've pulled out of this a dump of the data over here, and you can see that we've got around 200 odd incidents or observations, if you prefer, of companies, here they are, which have done rights issues. Now normally, in fact, for this type of study, we prefer to look at the announcement date of a rights issue, but I don't easily have access to that data. What I'm looking at here is the actual date at which the rights offer took place. And so this will normally be about 3 weeks before the rights offer, 3 weeks after the rights offer announcement, let's rather put it that way around. And you can see that we've got the date of the rights offer itself, and this is the amount of capital that was raised, and that represents 87% of the existing capital at the time. So some of them are quite small and others are much bigger. And we want to take that weighting into account here when we do our event study. So first step is to get your data. And essentially you need the date of the event, the share code, and if you're going to weight it in some way, we would like to know what that weighting is going to look like. Now, to run 200 odd of these is going to slow down my computer quite a bit. So I've just taken, in fact, about 10 or 12 of these, and I have dumped them already into my setup over here. Now you can see here is the list of codes that I want to look at. In fact, I've got 13 here. This is the weight that we have, and this is the date that the event, the rights offer, actually took place. And the next step is to construct what we call a set of event time. So you can see I am working from -40, and if I just scroll across here, you can see here, this is day 0 in event time. This is the day that the event date actually took place. But we line up each of these events into an event time model. So I'm starting with the event on day 0 for each one. This will be a different date, but as far as we're concerned, that is the day we want to examine. And then I work back 1 day, 2 days, 3 days, working backwards before the event, in other words, to see if there was any activity taking place in the share price prior to that. Often this will be a way of finding out if there was insider trading and that type of thing. But with a rights study, a rights issue, we know that probably these are trading days. So probably around about here, maybe a bit further back here, the company made an announcement that it would do a rights offer. Rights offers are typically done at a discount of, let's say, 15% to the current share price to encourage investors to put up their money. And so we would expect, in fact, to see a downward trend in the data already, simply because shareholders know there's going to be some level of dilution, usually not a lot, but 15%, depending on how much capital they're raising, is going to reduce the average share price of the shares. Now, we're also interested in what happens after the event, and you can see here, I'm running this in event time, and I've in fact run mine up 70 days after the event. We want to see what happened thereafter to the share price. So we set up this framework where we've got the codes and the dates and the weighting that we want over here. And then inside this matrix here, I am filling in the returns that I'm looking at. Now, in an event study, we have to be pretty careful about how we get this minus 0.2% return. It's not the shares return we're interested in here. It is the difference between what we think the share would have done without the event study and what it actually did when the announcement of this event took place. So to do that, we've got to work out the expected return on the share, and that'll depend on what happened on the market that day, the size of the share, what sector it was in, and various other things. And you can see here, if I just take you through to this formula that I'm using over here, let me quickly run you through this. So first of all, if I get an error, I want it just to put in a blank, like I'm pulling in here, just a blank number. Secondly, you can see here that if I want to put some constraints around the result I get, the maximum and the minimum, and I'm putting those constraints over here. The maximum return I'm allowing is 20% on one day. So if I get some really big numbers here, I'm just stopping them at 20%, or some very small returns. These are daily returns, so a minus or plus 20% return would be huge, probably pointing to some sort of error. I'm just capping them, putting limits around that. Then you can see in here, I'm using a kind of specially built function in Excel, actually, which goes into the database that we have already constructed of abnormal returns. And it's looking to find the return on a particular working day. In other words, not a public holiday, not a weekend, that happens to be 40 days before, in this instance, the event date over here. That's what why it's pulling out those two numbers over here. And then the last thing I'm doing, and that's what this amount here is, minus 0.2%, means the abnormal return, the extra return over what would have been expected for this share. And then we just, over here, we're taking B7 and dividing it by B4. And you can see that is looking at this weight as a percentage of that weight here. So I'm weighting this return down a little bit to represent, in essence, the weighted average return of this particular company. Once I've got that, I copy that across my entire set of data over here. And now I'm calculating something called the average abnormal return. So I'm just summing, you can see here, I'm summing these returns. So now I've got the average abnormal return that we would, weighted average actually, because I'm weighting them over here, that is a percentage of that for each share. And I'm adding them all up here, and it's telling me that on average, those shares' exceptional or abnormal return was 1.39% on that particular day, 40 days before the event took place. I then copy these returns across over here, and these returns actually tend to be very small numbers over here. If I were to plot a chart of these returns, you can see there's some days it's up and some days quite a lot, and mostly it's very hard to read this because there's the data is kind of quite small, and there's no obvious patterns over here. But if we accumulate these things, so I start with this one. In fact, we're going to start here on day 0, and we're going to accumulate them backwards over here. Let me show you that. So if I go across now to day 0 on my sample over here, and this is because we want to sort of center the data on this particular date. You can see on that day, the average abnormal return was minus 1.47. So on average, on the day of the rights issue, the shares all dropped on average 1.47%. That's quite a big drop. And so over here, I'm putting 0 in here as the starting point. And as I go into the future here, you can see I am essentially starting with 0, but I'm adding this amount to the cumulative return, and I'm accumulating these returns now for 40 days in this line here, and working backwards over here. I'm subtracting them. I want to see what happened to the share prior to this event over here. And so I've got my little formula up here. These are log returns. So I've got to sum them. I can easily sum them up like this. And then I must just use the exponential to bring it back to the correct return. And then I've got my cumulative average abnormal returns. This is what I'm really looking for here. Now, if I show you the plot of these, you can see a very interesting pattern. Now, ignore the thin red line and the thin green line. I'm coming to those. But what you can see here is that at some point here, the shares, here's my event date, date naught over here. I should probably highlight that a bit more here. That's somewhere here. And prior to this event, going back 40 days over here, you can see the shares were generally speaking coming down. And on day naught, because I make sure it's like this, they center around 0. Then you can see they're pretty flat. They drop a little bit over here. And then after a period of about 50 days, they start to go up here. There's not a lot of exciting stuff in here at the moment, but we do observe that they drop a lot and then they kind of settle down a bit, and then after a while they tend to go up over here. Now, I've only got a very small sample in here, and I'm just doing this to illustrate the methodology over here. Now, normally we'd want to do some statistical tests to see whether this return is within the normal range of returns or not. And to do that, I've constructed a 95th percentile. That's actually this thin red line over here. And this green thin line over here is the 5th percentile of returns. And to do that, what I've done down here is I've changed the model a little bit. And first of all, I'm constructing what we call a bootstrap distribution. Now, to do that, I want to pull out a random date. At the moment, these returns, if I just show you one over here, let's come over here. You can see, I'm hoping you can see that it's pulling out this date over here, which happens to be the same date as the event, which is what I want. But I'm now going to copy this formula over here, and I'm going to dump it on top here and just paste it there. At the moment, it just remembering what it had. If I press, and I don't want to recalculate everything here because it's going to take a bit of time. I'm just going to recalculate this one cell, and you can see what it's done is that's the actual event date, the 6th of December 2017. But my formula here says pull out a random day between that day minus 200 working days, in other words, about a year before this date, and don't go anywhere close to this date here. Make sure you're at least 80 days before this event over here. And if I do that, you can see every time I recalc this, I get a random date, which is between 200 days and 80 days prior to this date over here. So it's looking for this particular company and finding now random data, which it's going to populate all of this with based on, well, the data is not random. The date is random over here. And what I'm going to do here is I'm going to just use this. I'm going to run this model a number of times using random dates before the actual event to see what the distribution would look like. The cumulative abnormal distribution, in fact. So this is quite a complicated thing that we're pulling out of this, but it's going to give me tram lines which show me the 5th and the 95th percentile of what this data would look like without the event. Now, to get it to do this, I'm going to trick Excel. First of all, I've set up my little schedule over here. Let me just clear all of this out because I don't need this data at the moment. I'm going to reconstruct it. Now, I'm starting off here. Let me just go down a little bit here. I'm starting off here, and all I've done here is I've just put in numbers 1 up to 100 at the bottom over here. And in fact, I don't need these things either here. And then I'm pulling out on this in line 26 here. It's just replicating, in fact, exactly what you see in line, it should be line 3, I'm hoping. So if I go here, you can see it says look at D7. That is not correct. it actually should be, and let's fix it. It should actually look and see what that is. Okay, and let me see what I've done over here. That's correct. That one was wrong. But the rest are just simply looking to see what is the cumulative return out there, and they're replicating it down here. Now I want Excel to construct a data table here. And to do that, I'm going to highlight this range over here. Sorry, I'll leave out those numbers over there, but I'm going to go, in fact, I can leave them in. I'm putting these 100 numbers in here, and I'm going across here for 70 days. In fact, you can't see it. It looks all blank at the moment. And then I'm going to go in here, and I'm going to go to the data, what if analysis, and I'm going to construct a data table. And I'm going to tell it that I've got an input cell, which is actually just nothing. And I'm just going to pick any blank cell on the spreadsheet here, and I'm going to tell it to pretend. And it's going to take number one, put in the cell, but the main thing it's going to do, that does nothing actually, but it will recalculate the spreadsheet. And I'm going to say, okay. And at the moment, I've got calculate off on the spreadsheet here. It just dumps in a bunch of numbers over here, which are all identical. But if I press F9 now, it's going to run this data table. And off it goes, and it's busy doing it at the moment over here. I'm going to pause this because it's going to take a few minutes to do this, and then we'll come back in a second. Right, that took a few minutes to calculate, but you can see now what we have here are a whole lot of different runs of cumulative abnormal returns here based on essentially the same set of companies, but using dates which are outside the rights offer announcement date. And from this, I can now pull out the 5th and the 95th percentile range of what we would expect to see. And all you can see here, I'm simply taking the largest, the 95th, or in fact, in this particular case, I'm taking the 5th percentile here. It's because I'm using large here. It's actually the 95th. And this is the 5th percentile down here. And if you were to find the, rank all these numbers and take the 95th one, you would actually pull out 13.9% here and so on. And just so this doesn't recalculate again, which takes quite a while, I'm simply going to take my whole range here, and I'm just highlighting this here, and I'm going to copy and paste it as values. And so I'm just dumping those, and it won't let me because I need to include this one as well. Let me just try that again. And I'm just dumping those as values. Now, if I go to my chart, you can see it's actually now fitted correctly now, the confidence levels around here. And in this particular sample, because we don't really have enough companies here, you can see it's really telling me that although I'm sort of finding some interesting results here, I'm not actually really outside of what you could have got just with random data in here. So I'm going to run it again. I'm going to again put on pause with the full sample and show you what it looks like with all the data. Okay, so here's the result. As you can see, I've got all the companies now listed over here. And whoops, if we just go back here, you can see here they are. And there are about 200 odd of these. And down here, you'll see as well, I have now run the table for all of the different iterations here. And I want you just to notice one more thing, that these dates are equivalent now. So we've got the correct dates sitting in to run the model. And if we look at the final chart, you can see this is our final result. You'll notice that the confidence limits are nicely spaced here, and here we can see that up until about 20 days or so before the actual event, the sample shows fairly constant returns, and then there's a big dip here, which is significant because it's way beyond the confidence levels here, and And that goes right down below. What happens is a bit of an upturn here just before the event, and then shortly after the event, you can see after about 6 days, there's a very positive reaction of 5 or 6% over here, which stays there for quite a while and is definitely significant because it is outside these boundaries. I hope you found that useful.